the whole time. Oh my gosh, I was muted. I apologize. Thank you ever so much. I can't believe that. I've been muted the entire time. Well, it's just as well that the earnings will go out and be edited later on. But thank you for letting me know. No sound. Unbelievable. I've been talking for 5 minutes with no sound. If you're watching me on TikTok, you'd have loved it. But there you go. Definitely no sound. There is sound now. It's all sound now. I was talking for 5 minutes. Oh my gosh. Anyway, what about that? Okay. I'm not going to repeat myself because we've only got 4 minutes to go before it starts anyway. That was a bit of chaos. Never mind. It is what it is. These things happen. It's because I jumped from one stream to the other in like a crazy time, and it was quite a rush, but it had to be done, I'm afraid, didn't it? Plug power, just moments to go. We're listening in. Yep, let me just mute the sound there. We don't want any copyright issues. Let me turn it down. There we go. Let me bring it right back so you can't hear that. Okay. You can't hear that now, so we're good. We're running the sound in the background. We've got just a couple of minutes to go anyway. Welcome, everybody. If it's your first time, click subscribe and ring the bell. With this drop we've got here, plug is a good value. It might go a bit lower. It did miss on earnings. However, it's all about the guidance. We were expecting it to lose money because it's investing heavily in the infrastructure. It is undervalued now. There is a good opportunity on this. I'm going to have a closer look at this and see if I can squeeze. I don't want to do it. I don't want to buy anymore. I don't want to buy anymore at this stage. I want to hear what they have to say first. It's a strong buy. 65% analysis analysts say a strong buy, and that was done on October the 11th. And October the 11th, if we look at the stock, October the 11th, we were at a valuation of $7.35. We're at $5.29. It is oversold. It is good value. We've done the intrinsic value. We've looked at the solvency. It's okay to buy it now. I mean, it went down as low as, what did it do? It went down 20% on the news. I do think it's overreaction. It is a big miss. However, it's what you expect from a company like this. It's not going bust. I showed with you, I'll do it again. Plug. I showed you the solvency of the chart of the company. I beg your pardon. Plug power. Here we go. Let me just, Alan, we got 2 minutes. I've got 2 minutes to show you the value. It's definitely good value at overvaluation at 10%. And now this was before it went down. This was at a valuation of 6. It's gone down 20% since here. Undervaluation at best case by 60%, 10%. And worst case scenario, which actually be about 29%. At worst case, $3.68, but we don't value it there. That's the worst case scenario. We've got literally 1.5 minutes to go. The revenue is up. Look, we can see the revenue is up 14%. Things are moving very good. If we look at the balance sheet, this is what it's all about. It's got plenty of money on hand, $5.6 billion in assets, $1.8 billion in liabilities. If we look at the liabilities, we've got accounts payable, $220 million, other current liabilities, $383, long-term debt, $538 million. But when you look at the assets, we're at $5.6 billion on assets, so we're okay. It's okay. Solvency score is okay. It's amber. It's not glowing green, but everything is good. Low DE, low short-term solvency is good. Long-term solvency is good. Negative net debt. All of that is good. Just profitability because they're investing in the infrastructure. Great valuations here on the valuations. I'm giving it a good valuation. 543 on the upside, 158 on the upside, and 9% on the upside at the lowest target. So yes, it's a good valuation, and yes, it's a good buy at this level. Very small amount of inside trading, very small amount. We're not concerned. It was actually done by Crespo Jose Luis, who sold 230,000 worth of shares. Absolutely nothing at all. Not concerned about that. So we're all looking good. There's no real issue here. It is an overreaction. It is oversold. You could buy it. So I'll be looking for an entry if I can on this. So anyway, let's go into the earnings. Here we go. And away we go. We're just about to start. Just a few seconds to go. I'm listening in. We've got the audio coming through. The earnings will start any moment now.
Plug Power third quarter earnings call. At this time, all participants are in a listen-only mode. A brief question and answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press star 0 on your telephone keypad. As a reminder, this conference is being recorded. It is now my pleasure to introduce your host, Teal Hoyos, Director of Marketing Communications. Thank you, Teal. You may begin.
Thank you. Welcome to the 2023 third quarter earnings call. This call will include forward-looking statements. These forward-looking statements contain projections of future results of operations or of our financial position or other forward-looking information. We intend these forward-looking statements to be covered by the safe harbor provisions for forward-looking statements contained in Section 27A of the Securities Act of 1933 and Section 21E of the Securities Exchange Act of 1934. We believe that it is important to communicate our future expectations to investors. However, investors are cautioned not to unduly rely on forward-looking statements, and such statements should not be read or understood as a guarantee of future performance or results. Such statements are based upon current expectations, estimates, forecasts, and projections, as well as the current beliefs and assumptions of management, and are subject to significant risks and uncertainties that could cause actual results of performance to differ materially from those as discussed as a result of various factors, including but not limited to the risks and uncertainties discussed under Item 1A Risk Factors in our annual report or Form 10-K for the fiscal year ended December 31st, 2022, quarterly reports on Form 10-Q for the quarters ending March 31st, 2023, and June 30th, 2023, and other reports we file from time to time with the SEC. These forward-looking statements speak only of the day in which the statements are made, and we do not undertake or intend to update any forward-looking statements after this call or as a result of new information. At this point, I would like to turn the call over to Plug Power's CEO, Andy Marsh.
Thank you, Teal, and thank you for joining the third quarter conference call. This is a difficult quarter, driven primarily by the availability of hydrogen. Over the past several months, there has been enormous challenges associated with the availability of hydrogen, primarily due to down plants, including our Tennessee facility, and temporary plant outages across the entire hydrogen network. For many days, demand outstripped supply. For example, many of the California fueling stations have been without fuel or have had limited fuel on a regular basis over the past several months. Additionally, the price of these stations for hydrogen has been over $30 per kilogram at the pump, about twice the normal price. To service our customers, Plug has been moving hydrogen from the West Coast to the East Coast. This has been a yeoman's effort and has been accomplished while reducing the cost of hydrogen compared to the second quarter. Good news is the network is now stabilized and many of the plant outages have subsided, plus additional capacity will be coming online. We expect our Tennessee plant will be back online producing hydrogen by the end of the year. This plant, when fully operational, provides about 20% of our production needs. One of our major suppliers is upgrading one of their facilities to allow the plant to operate at full nameplate capacity in the coming months. The plant output has been producing between 0 to 25% of capacity. We're continuing to see progress at our Georgia plant, and we're finishing the last step in the construction process, commissioning the liquefier. We expect the plant to be online by year end. A few other points. Stress hydrogen network also caused a delay at deployment of some of our North American material handling customers. These sites will be commissioned as the hydrogen issue is resolved. It's just a timing issue. Many of those facilities, actually, the fuel cells and hydrogen plant or fueling structure are already available. We believe, though, that this experience reaffirms the criticality of building our nationwide hydrogen network to support our fuel cell business, as well as the financial benefits that this network could accrue to the company for both that business and the additional applications that are beginning to be realized. Furthermore, this experience underscores the wisdom of our business diversification model. In the fourth quarter, we anticipate that revenue from our new ventures will surpass revenue from our traditional business for the first time as our electrolyzers and cryogenic businesses continue to grow. Finally, I just like to reflect on a conversation I had yesterday morning with a European customer, supplier, and partner. He just toured our facilities and reminded me that no one has built hydrogen infrastructure on the scale we have. No one has our product set. No one has the technical talent. No one has our customer relationships. And no one has our real-life experiences. It remains our belief and his that as the market for hydrogen fuel cells grows, no one is in a better position than Plug to take advantage of this opportunity. This is just a bump on the road. Paul, Sanjay, and I are now available for questions.
Great, thank you. We will now be conducting a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we poll for questions. Thank you. Our first question comes from the line of Colin Rusch with Oppenheimer. Please proceed with your question.
I want to start off with the balance sheet. You've got a fair amount of restricted cash. You offered a fairly reasonable update in the letter around your process with potential funding sources. I guess the real question is around timing and how you see your ability to free up some of that restricted cash and start to bring on some of those or close one or more of those deals that you're talking about in the shareholder letter.
Yeah. Sure, Colin. I'm going to let Paul take that question.
Yeah, good afternoon, Colin, and thanks for the question. We continue to pursue a number of initiatives. We've had many inbound expressions of interest with different terms, and we continue to work through what we think is the best and most prudent solution. It's not for lack of options. It's really just continue to be picky around which ones that we've had to act on, and we haven't felt the compulsion to act quickly. We're taking our time to be thoughtful about which choices that we have. I'll tell you on the DOE process, many people will ask about that. We're progressing very well. We continue to have great effort and collaboration with them, and we expect that will get through the 100-page long-form term sheets that they need to get through to submit for contingent approval here by the end of November, and we still expect there's a good chance we can announce that program by the end of the year. That'll be very meaningful, and we continue to pursue a range of other options, and so I expect something in the near term.
Okay. And then on the operations side, with the impact around the hydrogen availability, can you talk about the cadence of deployments for material handling and how that's impacting some of the equipment sales that you guys are working through for the balance of the year and into the early part of 2024?
Yeah. So, Colin, we left the quarter with 7 sites, which we couldn't bring online, which would have represented well over $50 million in revenue because of we couldn't put more stress on the network. And so we expect that we will have a good quarter for material handling. I'm just going to caveat it by saying that first and foremost, we have to make sure, especially during this holiday season, during peak, that our key customers have hydrogen. And as I mentioned, we've done a really good job in moving hydrogen. Without our fleet of over 40 trucks, we would have never been able to do what we were able to do. So in my opening comments, I said it was a timing issue. I think if the network continues to improve, it probably will happen this quarter. But I think there probably could be when I think about our material handling business, a swing of, between, up to about $50 million, I think is possible. That being said, I think the letter highlighted this. Some of those customers that we've gone through this with have actually increased the number of systems and the number of material handling sites they want. We've added new customers, Tyson. We've added new customers, Ryder, and others. So it certainly has been a challenging time, but it's pretty remarkable how well we've done so far in keeping hydrogen available for our customers.
Excellent. Appreciate it, Andy.
Yeah, sure, Colin.
Thank you. Our next question comes from the line of Manav Gupta with UBS. Please proceed with your question.
Hey guys, help us understand. Hi. So help us understand the path to positive gross margin here. I think that's the number one question we are getting. How do you get to positive gross margin and by when?
Sure. Paul, do you want to take that? And I may add on some items, but do you want to explain how we get there?
Yeah, sure, Andy, and thanks for the question. I would tell you a couple of fundamental things. One, Andy mentioned this quarter, the revenue from these new platforms are going to be greater than our legacy business. Most of those platforms, and really all of them, are equipment platforms. And if I don't know if you've seen our new facility up in Vista or Rochester, but we're poised as we start scaling all these new platforms up for substantial volume leverage. And if you look at sales in Q4 and on into into next year, really the bulk of the growth is coming from these equipment platforms. And we've shown historically with material handling, as we scale that business, that every time we double the installed fleet, we've been able to reduce the cost by 25%. And you're going to see the same trends as we get volume leverage, you get supply chain leverage, you drive greater automation. So equipment sales is really key, and that's one thing you're going to see as we move past launching these new platforms and through the pilot programs into really scaling them. Second thing you'll see is on the fuel margin. You already see some abatement in the prices. We expect some additional abatement in Q4, but the real step function change in fuel happens as we turn on our own facilities. And so Georgia's coming online this quarter. Tennessee will be reinstating and turn that back up. and then we're looking to turn on the new facility in Louisiana towards the end of Q1. And so those will be very accretive events as we start to turn those facilities up and start to be able to, source a lot of that hydrogen from ourselves, which in many cases is at least 30% cheaper, is 30% of the market cost that we're paying today. In some cases, only 10% when you factor in the PTC credit. So those are the most two massive effects that are going to have on margin in the near term, and we expect that to start see that in Q4 and start to really ramp as we move through 2024. Andy, you have other comments you want to share?
No, I think you're right, Paul. I mean, I think the equation's really right. We have to deploy more equipment, and we'll be deploying more in the fourth quarter. We have to get the plants up and operating. That helps a great deal. And look, we have a clear plan on service margins. I think the best plan we've ever had. And I think all those factors will come into play.
My quick follow-up here is we are waiting clarity on the PTC. When do you think we can get something, and what do you think would be reasonable at this point to assume some level of, what do you think would be reasonably good outcome for you in the PTC guidance that does come out?
So, the administration has shared this week has been that they will have the PTC announcement out before year's end. I suspect that that's probably about right. When I think about the PTC, we think that really the key item is how regionality is defined. And, if regionality is defined to be the balancing authorities, where there's 69 in the U.S., probably most of our future activities would go on in Texas. If the regionality comes out to be the ISO regions, we've looked at that and have concluded that it's that would work for Plug almost regardless of where they come out with additionality. We think you probably need 3 years. We also think that if you think about time matching, it's pretty clear that Treasury has realized that hourly time matching doesn't work because the rec market for that really doesn't exist. I think that's actually something that looks like that will be the final outcome. It won't be the perfect outcome. A broader regionality, east, west, and ERCOT would be the, I think, best solution for the growth of the hydrogen industry, and would coincide. And I think this is where I think a lot of people would miss. It really needs to be broad for the hydrogen hubs to work. And certainly I can tell you I've spoken with high-level leadership at the DOE, and they understand that. So I think Plug's going to be fine when the guidance comes out. I think the industry will be fine. I hope that it's done in a way that all regions of the United States are winners.
Thank you so much.
You're welcome.
Thank you. Our next question comes from the line of Bill Peterson with J.P. Morgan. Please proceed with your question.
Hi, good afternoon, everyone.
Good afternoon, Bill.
So I'd like to dig a little bit deeper into Colin's questions on the cash raise and shoring up the balance sheet. So you talked about corporate debt solutions. Can you provide more color or what kind of options, what kind of facilities you're talking about here? On the DOE loan, you're hoping to announce something later this year, but it talks about conditional. What is it conditional on? And then, when could the dollars actually flow? I guess, can you confirm that this is milestone based? And then finally, I think for these project financing, I guess when could these be solidified in order to shore up the position? Really, just overall, how should we think about your ability to shore up your kind of cash position in the near term?
Paul, do you want to take that?
Sure. There's a lot of questions in there, Bill. I'll do my best. First on the DOE, it's a good news, bad news. The fact that they require a very detailed long-form term sheet is actually, although it takes time to work through, is extremely helpful, because the way the process works is, they effectively put the package together and all of their diligence reports and submit it for the final approval, which once it gets approved, you then have to go and actually put the agreements in place. But because it's 100 pages of long form term sheets, in effect they've already kind of worked through all those key things, so that should be a much faster process. The framework that we're working on with them is a $1.5 billion platform that would fund our green plants and would fund from construction phase onward. So, and it could be upwards as 80 cents on the dollar. That's the framework that we're working on, and we're working very diligently to get that in place. In addition to that, we've had some expressions of offers for ABL-like facilities. We've had some expressions of offers for restricted cash advance facilities like we used to have with Generate. So there's been a number of parties that have expressed interest for project equity on some of our initial plants. So we have a range, and there's been a number of other ones in different forms, and so we have a range of solutions that we continue to work through, and we just are wrestling through what we think is the best choices and the best options given the dynamics and what we're trying to accomplish here. So, I think the DOE could be, even as early as late as end of Q1 potentially, more likely early Q2. It starts funding, and it could actually go back and back lever some of the existing plants like Texas and maybe even New York. And I think some of these other facilities is what we'd probably leverage into is to complement that structure for general working capital and other project capital that we would be advancing on. So hopefully that helps, Bill.
Yeah, no, that's a good additional context. Just how to think about the fourth quarter. You at the time of the symposium, you took down your numbers to the bottom end, but presumably the headwinds you talked about with hydrogen is impacting your ability to provide, fuel cell systems for the fourth quarter. So I guess walk us through, if you could, revenue assumptions maybe by product type and how we should think about how the fourth quarter could evolve, given all the puts and takes you've talked about with all the issues in hydrogen.
I'll take that one, Bill, because we spent a lot of time thinking about this. So, I think that if you think about as a base of 1.2 billion, where are the risks in the 1.2 for the year? Because of hydrogen, and I think I mentioned earlier in this call, we think there's a risk of, circa $50 million in our traditional business. And we also, when we look at our cryogenics business, which has really been one of the strengths this year, and there's some timing on some deals where we think 50 million could flash in, go into the first quarter instead of the fourth quarter. They're really the two items we're looking at and really watching closely. I think we're feeling good about our electrolyzer business. We feel good about, the revenue, all other revenues in our, our trailer business, our cryo, other activities in our cryo business. But that's really kind of the breakdown we see. So if you think about that, we think, 60% of the business, when I outline those numbers, are for electrolyzers, for cryogenic equipment, and 40% is our traditional material handling business. So that's kind of the give and take from 1.1 to 1.2, Bill. Did that answer your question?
Yeah, no, that kind of describes, some of the risks associated with the rest of the year. It sounds like electrolyzers are still, you feel good about that, if I can paraphrase?
Yeah. I mean, I feel really good about material handling. I just got to make sure that we feel real good about electrolyzers. We feel real good about some of the expansion activities with our cryogenic trailers. We have this liquid refueler, which is, for buses and others. It's really sold, and we can't make enough of them. So we really do feel good about those things. And I have the parts built for material handling. It's just a question of making sure that we can bring them online in a way that meets our customers' needs.
Thanks, Andy.
You're welcome, Bill.
Thank you. Our next question comes from the line of Chris Dendrinos with RBC Capital Markets. Please proceed with your question.
Yeah, thank you. I guess I just wanted to discuss the hydrogen availability situation. Obviously the force majeure events are they've been reoccurring kind of throughout the year. When you think about that business and sort of your suppliers, is there anything you can do, I guess, more that could be done to ensure stable supply? Is there like the ability to have some backup suppliers or anything like that that you can speak to? Thanks.
So Chris, I think what we're doing, I mentioned 3 items. There isn't additional hydrogen available. I was talking to someone today who told me they couldn't get any hydrogen. When what we look at it though, our plants coming online help a great deal. Having Tennessee and Georgia up, that provides us 25 tons of hydrogen. Bring St. Gabriel's up in the second quarter, brings another 15 tons of hydrogen. That's 40 tons. I met with one of the other major hydrogen suppliers in this industry, the president of their Americans operations, on Tuesday. We sat down and they're bringing online 30 tons by putting SMRs in to replace some waste stream stock that hasn't been coming. So I do see that by the end of January, there is an additional 55 tons. And just to give you a feel, 55 tons is approximately another 20-25% of hydrogen availability. Now we're going to use more hydrogen next year. We are projecting that our hydrogen needs and demands will grow by 40 tons by year's end, and that's why Texas is so important to us to bring that online. And that'll, we're working through that one, but that one is really will be critical for the second half of next year to make sure that by the late fourth quarter, that's able to produce to support the customers. So the good news, Chris, is this is not going to be an issue on January 1. We just got to work through the final stages here.
Got it. Okay, understood. And I guess maybe just as a follow-up, maybe on a slightly different topic here, it's just the equipment sales margin in the quarter. It looks like it was negative. Can you just walk us through the dynamics of what's going on there? It sounded like it might have been mix related, but I guess any just additional color on what's happening in that segment. Thanks.
Paul, do you want to take that one?
Sure. So, Andy mentioned about some of the programs that pushed. Scale matters for us. When you think about these manufacturing facilities we have and driving volume leverage, that's important. So that's part of the driver. Another part of the driver is some of the cost associated with launching these new programs, especially some of the early pilot programs. I always say it's hard to make money when you build one of something, but as we start scaling this up to hundreds and then thousands, you really start to drive not just volume leverage, but supply chain leverage and you can drive improvements in your manufacturing processes. And so, those were really the key drivers this quarter. And we certainly expect that to be, meaningfully better in Q4, given the ramp of these equipment sales. And then on, you'll see that ramp even more so in 2024.
Got it. Thank you.
Paul, I think it'd be fair to say also that that $50 million material handling revenue would have flipped it the other way.
It certainly would have been super helpful in moving in that right direction, Andy. Yep.
Thank you. Our next question comes from the line of Jordan Levy with Truist Securities. Please proceed with your question.
Afternoon, all, and appreciate all the color. Maybe just a high-level kind of strategic sort of question here. If we kind of look out to 2024 and recognizing you're starting to get some of your own volumes online, but if some of these other issues in the network persist on the supply side, I'm just curious how you think about sort of balancing growth on the materials handling side versus timing of your own plants ramping, and whether it makes sense to throttle the materials handling down a bit as you kind of bring on your own supply and that sort of thing.
Jordan, thank you for the question, and I think that is a good question. As I mentioned, we feel that we'll be in a much better position come January 1. And one of the reasons I've gone around and spoke to leadership with other big suppliers in the industry, and we've talked about making sure we talked about what their plans are, which are public. So there's nothing that's being hidden here. We feel that we can continue to grow and expand that business. And that's, I think I did some math for you, which, combination of St. Gabriel's, combination of our 25-ton coming back online, that's 40 tons. I talked about an additional 30 tons coming online from another supplier. I do know that other folks are beginning to look at putting some hydrogen in the market. For us, it really needs to be liquid, but we really don't see the need, Jordan, to throttle back.
Thanks for that, Andy. And then maybe just a follow-up on the stationary side of the business. I know these are kind of bulkier shipments, but it seems like from the shareholder letter, you've made some good traction there going into the fourth quarter. Just an update there, if we could.
Yeah. So we will be shipping products. First, let me, and I don't know, because it was at the symposium. Actually, it was one of the first days. The first product that we deployed was fully operational and working. That product is in many ways so much more challenging than our material handling products, but so much more simpler once you get it going. I say it's more challenging because it's a complicated system. I mean, 1 megawatt of power, how to manage all that hydrogen and water, all those items are really, really critical. The fact it runs at almost constant power, the fact that you're not moving it around. The product has worked remarkably well the first deployments. To the point, Jordan, about 2 weeks ago, I wasn't hearing anything about the performance of the product when it first went in the field, which, in my 40 years working engineering products is incredibly unusual. So I picked up the phone and called the customer and asked them how it was going. And, it's been working remarkably well. So we're really upbeat about that product. We'll be doing good deal of deployments. A lot of the extra hydrogen for next year will be associated with that product. So we're really pleased. It's probably one of the more challenging, but one of the best product launches I've ever seen in my career.
I appreciate that, and thanks for all the details.
Yeah.
Thank you. Our next question comes from the line of George Gianarikas with Canaccord Genuity. Please proceed with your question.
Hi, everyone, and thank you for taking my question.
Hi, George.
How are you?
Okay.
I wanted to ask about an early glimpse, if you can, and someone may have alluded to this earlier, to 2024 and 25, just sort of gross margin, high level, particularly in light of the fact that you have the updates you've made to your green hydrogen generation. Thank you.
Paul, do you want to take that question?
Yeah, I guess, we have our January business update scheduled, most likely towards the end of January, where we'll give, as we always do every year, more specific numbers, for 2024, as we kind of center in around our finalizing our plans and forecast. But I guess what I would tell you is, directionally, we absolutely expect it to go north. And, when you think about the equipment programs and those starting to scale up, and you think about the fuel sites and how meaningful and impactful those are, I think, next year, I think we could not only be positive, I think it could be in the low double digits, directionally, and then scale up from there. And I think there'll be another big step function in 2025 because we're turning on Texas and targeted to turn on New York. That's 115 tons per day of capacity between those two facilities. So that's a substantially meaningful revenue and margin accretion of those programs, if as those given those forecasts of what we're planning to do and turn those on. So I think directionally that's kind of how it will play.
Thank you. And as a follow-up, different question, I know we're waiting for Washington to make a final determination as to how it views PTC, and so I'm curious if you can help us compartmentalize, based on the different outcomes, how do those impact the numbers? In other words, you've given some long-term guidance, and when you think about, outcome X in Washington means this to our forecast, or outcome Y means that. How could we think about your long-term forecast when we hear the final outcome from Washington? Thank you.
That's a good question, George, and we've always taken a very, very conservative view of the outcome. We built the models and our plans not based on the PTC being available. We know that the PTC will unlock additional opportunities, but and further guidance on other elements of the IRA. So I would just say that if you think about it, it probably has minimum impact, whatever gets said, for 2024. Even though people are waiting, it still takes time to get to FID, especially on electrolyzers. I would think that our forecast may be different in the 25-26 time frame with a PTC outcome that's, I'll call it, middle of the road. That's how I would think about it. Sanjay, I know you've been thinking about this too, but that's kind of my view. But since you're deeply involved in the electrolyzer sales funnel as well as the sale of hydrogen, do you have any additional comments?
No, I think, Andy, you sort of summarized it pretty well. But the only thing I might add here is I think we are obviously been working on multiple large-scale electrolyzer opportunity here in the U.S. And as the guidance becomes clear, and as we hear more about that, I think some of this opportunity that we've been working on start to unlock. And even on the electrolyzer side, even before some of this PTC guidance, we had talked about working on 3 mega deals. We've already announced 100 megawatt in Europe. We've already announced another 280 megawatt in Europe, and we have talked about, being a preferred supplier for a 550 megawatt opportunity in Australia. But with this PTC, we certainly see meaningful growth for electrolyzer business, as you said, Andy, especially in 2025 and 2026 timeframe. But there'll be a very meaningful growth as well in 2024, given the mix of the business, diversity of the market, and then existing backlog.
I mean, there are more products that need hydrogen coming online. There are folks who are going to want green hydrogen, to meet their corporate goals, regardless of the status of the PTC. So I think the PTC, a middle of the road decision, will be really beneficial for Plug. Thanks, George.
Thank you.
Thank you. As a reminder, press star 1 to ask a question at this time. Our next question is from Eric Stine with Craig-Hallum. Please proceed with your question.
Thanks for taking the questions.
Hi, Craig.
Hey, so I've been jumping around on calls today, so I hope that I don't ask something that's already been asked. I did hear the end of the last one. I'll just stick with the IRA just for a second. Hearing some talk of regionality, in terms of where power needs to be sourced from. Just curious if you could expand on that a little bit, and what would you see that doing for your business?
Yeah. So I think, Eric, if regionality is really tight at the balancing authorities, and there's 69 balancing authorities, I think it drives most of the business activity into ERCOT. I don't think it's going to end up there. When we think about a middle-of-the-road solution that would work for Plug, and we think work for most people in the industry, that would be, use it. The ISO regions would, we think, work. There's rec markets which work there. The regions are big enough that the additionality issue should be much more minor. Ultimately, you could phase in time matching, and it probably would work. Probably what's best for the nation, and what's probably best for the U.S. leadership in hydrogen, it would be having just 3 regions. That would also make sure that most of the hydrogen hubs could be successful. That's I think from a Plug perspective, it probably will end up where we're operating more, and probably, quite honestly, probably many of our customers. I think from a nationwide rollout perspective, many regions is not helpful. So the bigger the region, the quicker the deployments will happen, the better it'll be for our business. But if it's the ISO regions, we'll be in good shape.
Okay, that's helpful color. I guess we'll stay tuned on that. And then maybe, so it sounds like you did for 2023, provide a little color around. I think the previous outlook had been $1.2 billion, and that there is some $50 million or so variability in that number. I'm curious if you discussed any of the out year targets. I mean, I know 24 in the past you'd had a $2 billion plus revenue target, and at the symposium you had 27, you had 2030. So just curious. I mean, did you address that? Are you making any changes, or is that something that's more for the January update?
Paul explained, Eric, to people, it was the January update call.
Okay.
So we did not make.
Did make changes. Okay. Thank you.
Thank you. Our next question comes from the line of Andrew Percoco with Morgan Stanley. Please proceed with your question.
Good evening. Thanks for taking the question. I did want to come back. Hey, Andy, how are you? I did want to just come back to the balance sheet and financing line of questioning because I do think it's important here. So in the quarter, it looks like you burned $400 million of free cash flow, which leaves you with about $550 million of unrestricted cash and available for sale securities on the balance sheet. And Paul, I know you laid out DOE timing late this year, but it sounds like that's project milestone based. And you also announced, the Fortescue potential financing at the project level, but it still sounds like that's early stages. So it's leading me to think that you'll probably need to do something at the parent level to manage working capital within the next few weeks. One, is that correct? Two, are you still confident that you can do it with debt? Is there a potential need for a convert or equity here? And three, can you just give us a sense for size in terms of what you'll need to manage working capital and the profitability drag over the next few quarters? Thank you.
Paul, do you want to take that one?
Sure. So a couple of things. Fortunately, we're kind of in this period where we've spent largely what we need to for Georgia to turn that on. We've also, the balance that's left for the Louisiana plant is not in context is not very big. So we're Texas is really kind of more middle of the year on into the back of the year when the big chunks of money get spent. So I think we have a little bit of latitude on CapEx, this quarter, next quarter, in that regard. And then on top of that, given the scale of sales that we have this quarter, that obviously, as we convert that into cash, that helps. And then thirdly, we're laser focused on reducing our inventory levels. We've built that up substantially to kind of help launch these broad platforms. But there's a substantial amount of capacity there that we can tap into that we'll see. You'll start to see some of those benefits happen in Q4 and on into Q1 as we start leveraging that liquidity pool. But you're right. I look at it as fungible, right, to fund our plans, and we've talked about what our focus is, and we're certainly focused on a range of solutions, and some of the more near-term ones could include things like the ABL or restricted cash advance facility like we had with Generate before, or some of those other structures. But I think we're in a good position given the positive effect of that as working capital between receivable conversions and inventory, as well as that lull period of CapEx that allows us to be a little bit more thoughtful as we move through this quarter and into next quarter about what we do and when we do it, and picking the best solutions for Plug. Hopefully that helps, Andrew.
Yeah, that's helpful. And maybe as a follow-up question, just related to your electrolyzer business, I think you guys have cited over a 2 gigawatt backlog. Can you maybe just help us think about how many of those projects have reached FID? Just trying to get a sense of how we should underwrite that 2 gigawatts we've seen, obviously, across wind, solar, battery storage, some issues as it relates to financing and supply chain. I'm sure it's the same for hydrogen. So I'm just wondering how many of those projects have reached FID at this point. Thank you.
Sanjay, do you want to take that one?
Yeah, happy to do that, Andy. So Andrew, it's a very good question. So let me give you some context on that, right? In that backlog, we have a lot of 5 megawatt system, right? And these are for a lot of different customers. So they obviously have all gone to FID, and that represents at least about 30 of those 5 megawatt system. Second, we talked about a big project with a customer in Europe that's already gone through FID, and that's a 100 plus megawatt opportunity. And this preferred supplier deal that we've talked about, that project is expected to go to FID before the year is over. Then we have another project that is actually looking for an offtake that is for the sustainable aviation fuel, expected to go to FID sometime next year, right? So keep in mind, though, the way the revenue works for us in our electrolyzer business is we have a standard stack sale That's a direct sale, right? Then we have 5 megawatt product system. That's a direct sale. And with the project business, we end up doing it on a percentage of completion basis, which actually really builds that base of business for us as you start to think about Q4, as you start to think about 24, and also 2025. And there's some other pretty substantial projects here, Andrew, that we have been working on for 6 to 9 months. I mean, they have funding in place, and some of this project, they're really looking for some clarity from the guidance standpoint, and we do expect that, either by the end of this year or early next year, you will start to actually see some of this project also move ahead and becomes a pretty meaningful contributor to revenue. Again, these are mega projects. They'll be multi-year and really start to build that base of business. And one other thing that I think is worthwhile highlighting here as well is both on our product side as well as on our project side of the business, in all the new bookings, as Andy and Paul alluded to, we've been very focused on cost down, margin expansion, and that's the trend. It's not just the top line. We will also start to see that margin progression as you go into 24 as well as into 2025, and that's how we're looking to plan all these things.
Great. Thank you. I'll take the rest offline.
Thank you.
Thank you. Our next question comes from Amit Thakkar with BMO Capital Markets. Please proceed with your question.
Hi, good evening. Thanks for taking my question. I just wanted to follow up. Thank you. I just wanted to follow up, Paul. I guess I'm not as familiar with the restricted cash facility you had before. One, like, will any of the $1.05 billion in restricted cash you have right now kind of basically work its way into the unrestricted bucket? And then how does that facility work? And I've got one follow-up.
Yeah, Randy, I assume you want me to take that.
Yep.
So, as we've done in the 10 years I've been here, probably $2 billion worth of sale leaseback transactions to monetize tax credits on some of our programs with some of our customers. Some of our customers like to own the assets. They like a CapEx model and buy. Some like to access our solutions and effectively lease it from us. And so what we do is we package it and sell it to a bank. And in those cases, the best place to monetize those credits, the most efficient place, is in the traditional bank market, like a Wells Fargo or those kind of institutions. But they're the most regulated as well, and so they often make us collateralize some of the investment tax credit in there. So that's what a lot of that represents, and so it does get released to us about 20% per year. So out of that balance, that $900 million, $950 million number that we have, probably around $200 million gets released to me, including $50 million in Q1. There'll be $50 million this quarter. There'll be $50 million in Q1. It's up to about a $50 million per quarter release rate.
Okay, and then you guys have, I think, said this a couple of times in this call, maybe some of the other calls, that you guys have kind of you're working through kind of several options for financing and trying to pick the best one. But it looks like you guys added some going concern language in the 10Q, and I was just wondering if that kind of maybe narrows the options that you were exploring previously.
Not really. I mean, we have the language that we've included is oftentimes driven by accounting standards and how you have to evaluate it and manage it, and it's a lot more conservative, obviously, than what we feel like. But I have a $5 billion balance sheet that's unlevered. I mean, I really don't have any debt, so we still are extremely confident about the range of parties and solutions that we're working with, and we haven't seen any tempering of interest. Given, I mean, it's not news where we sit with our liquidity position and where we're at. We've been pretty clear about that all year, and what we're doing and where we're going. So, I think most people certainly understand that and appreciate where we're at and what's to come, which is all this growth and this margin accretion and where it's going. So that's what people are betting on when they want to work with us, and so we don't really see it as limiting our options.
Thank you for the time.
Thank you. Our next question comes from the line of Sharif El-Maharabi with BTIG. Please proceed with your question.
Hey, everyone. Thanks for taking my questions.
Hi, Sharif.
Hey, Andy. So first, I'd just like a little bit more clarity on the service accrual charge. It makes sense, of course, that the hydrogen shortage affects cost of service, but how have these unplanned outages delayed fleet upgrades for customers?
Oh, well, that's. I'm going to give you an answer. I hope you understand. Hope it's understandable. So I'm going to separate into different issues, Sharif. It does slow down upgrades because, we have a fleet of 20 plus rolling hydrogen generators. Our service folks, now are out on the hydrogen pad almost every day, often connecting and reconnecting and, getting our products positioned that one can connect a high pressure tube trailer to. It also, when you start running hydrogen down to very low pressures, which happens often when you're running with these kind of issues, you end up cavitating the liquid hydrogen pumps. So therefore, you're doing a lot more maintenance on the hydrogen pad. So it has a ramification to that. But let me take it further. So it does impact. It does impact how fast you're implementing because your staff is doing things to keep the customer alive today. So that's why. Now, when I think about the service accrual, I believe that if I take a look, and I'm going to talk about our traditional material handling business, our confidence level that and we see it, the newer products we put out in the field perform much better, or the latest design, do not have issues. Our legacy units, take a lot of time and effort, and I quite when I look at it, I would not be surprised if over the coming next 2 quarters we have maybe an additional service accrual, and I think that, but I believe that we're in a place where that business, once we get through the legacy unit issues, which I think the accrual helps us with, we'll be in a place, in the second half of next year where that line could go in the other direction, could go gross margin positive. But that, and then I look at our new businesses, and I made references on the call earlier. It's much more interesting. It's much more simpler for our electrolyzer business and for our stationary business to essentially monitor those systems remotely, dispatch people if they need to make repairs. All those things actually help. We think those businesses will start off with positive service margins to start. So that's kind of how I know that's a long answer, Sharif, but that's why there's a connection.
A long answer, but really good window into nuts and bolts of the business. So I appreciate it. And then a little bit shorter of a question, I guess. When it comes to converting,
and I'm trying to make it a shorter answer, Sharif.
When it comes from converting the 15 tons per day in Georgia from gaseous to liquid, is it just a matter of adding a liquefier, or is there more of a retooling process involved? Really, I'm trying to drill down into what's driving the decision to have 15 tons gaseous and then the other 15 tons liquid.
Oh, that's it, the gaseous, Sharif, feeds the liquid. So there's not 2 plants. we are looking at the possibilities of expanding Georgia, but Georgia's a liquid plant. There is a 2.5-ton gases plant that we have there, which is filling these high pressure tube trailers I talked about, which are kind of like high pressure generators on wheels. And but the hydrogen that's produced primarily at the Georgia plant feeds the liquefiers. Does that make sense?
Makes total sense. Andy, thanks very much.
You're welcome.
Thank you. Our next question comes from Vikram Pragri with Citi. Please proceed with your question.
Good evening, everyone.
Good evening, Vikram.
To start off on Georgia facility, can you provide some risks that could delay the startup beyond 23, and if any of the funding options that you talked about are contingent on Georgia up and running? And then, staying on the same topic, inventory is now over $1 billion. Can it be a source of liquidity as you go into next year? How do you see that trending? And then finally, the quarterly filing has, as you talked about, some cautionary statement about funding being insufficient for operations next year. Any chance you can quantify how much minimum funding is required, assuming tighter controls to go through next year, assuming funding environment is not as supportive? Thank you.
So let me take the Georgia question, and then I'll let Paul deal with all the financial questions. So when we look at Georgia, we're at the final steps of drying the cold box, the liquefier out, and you have to dry it out to bring it down. So we heat the whole liquefier up to 450 degrees and essentially dry it out to ensure that when you start running at 25 degrees Kelvin, which is almost absolute zero, you don't have anything in the liquefier that would impede its performance. There are 8 kind of elements that need to be dried out. And so last night we dried out the first of 8, which took only 24 hours. I don't expect the others to go as rapidly, but that's really kind of making sure that liquefier is completely dry before we turn it on is one of the risks. The liquefier's been tested before it's left the supplier, but there is always it's a big difference bringing up in the field. There's a lot of confidence it'll come up cleanly, but that's probably where the risks reside. So that's how I think about it. I'll let Paul answer the rest of your question. So when it comes from the finance point of view.
Yeah, there was a lot in your questions, but let me try and do my best. A couple things. Anymore with the filings, I mean, the way the rules have progressed and the regulations, it feels like 80% of what's in my filings anymore is risk factors and caveats, right? So we follow the rules. We're compliant, and we want to make sure we're disclosing and doing everything according to the rules. But so that's what we do. And but in terms of the financings themselves, they're not. It's not like they're contingent on Georgia being turned on. That's not a caveat to us making the decisions on which ones we're going to pick. It's not. There's a whole range of options that we have available to us, and it's really, again, back to just us being prudent and thoughtful about what choices we're going to make. In terms of the amount of cash that we need next year, really we're in a great position because a good position, I would say, because you look at the fact that we've largely spent what we need for Georgia. We're by and large, we don't have much left, relatively speaking, on Louisiana. We can pace Texas and New York, the big facilities, kind of commensurate with the right solutions and trying to figure out which of those are the right solutions. And when you look at our growth, we'll talk more about it in the January business update, but given our forecast for next year, both in terms of top line and margin, we should be in a good position to middle to latter part of next year. We could be crossing into the positive operating cash flows. And so, really, in the big scheme of things, it's not a lot to kind of get to that through that bridge, to where we need to be. And life changes for us dramatically as we cross that threshold, and we in terms of access to institutional money and funding the next round of projects and things that we're doing. So, we'll certainly talk more as in the January business update and as we get through our year-end filing. But we feel good about the range of options that we have and the position that we're in and where we're poised to fund our business plan in the near term.
Thank you. And in terms of inventory, is that sort of like a source of liquidity for you guys in the near term? Can you bring that number down meaningfully from $1 billion now?
Yeah, we absolutely can and are focused on it. So, when you're scaling a bunch of new things at the same time and you're kind of focused on speed to market and scaling up the breadth of platforms, it's hard to focus on efficiency and optimization as much. But now that we're really starting to scale those products up, we're able to kind of, think more and ramp more from an optimization and efficiency standpoint, and also time things better and work with the vendors better on deliveries and consignment and other tools that we use that can drive that down. But it is a substantial source of liquidity, and obviously means we can spend a lot less as we ramp that down in the near term.
Thanks a lot. Appreciate it.
Thank you. Our next question comes from the line of Martin Mallow with Johnson Rice. Please proceed with your question.
Thank you for taking my question.
Good evening, Martin.
Good evening. I was wondering if you could maybe talk about nuclear operators as potential customers for electrolyzers.
Sure. Do you want to take that one, Sanjay?
Sure, Andy. Again, Martin, it just makes a lot of sense, right, in terms of when we think about all sorts of clean energy and how some of those clean energy can be used to produce green hydrogen. So, look, we have some effort going on along those lines, so there are some activities happening. So we certainly see that as a part of our electrolyzer business opportunity, whether it's just a direct electrolyzer sale or does that also expand into potentially even building a liquid plant there. But it's a very fair question, and short answer to that question is we have some of those activities going on and look forward to sharing a lot more with you all. And again, some of these areas, whether it's nuclear or some of the other opportunity here in the U.S., this bigger opportunity, I think, are going to get unlocked here as we get further guidance surrounding what exactly is going to be the language from the Treasury on the PTC and IRA.
Great. And for my follow-up question, just wanted to try to get a sense level of interest that you all have in maybe monetizing some of these green hydrogen plants as you bring them on, in terms of selling down interest in them. I saw the Fortescue news that you shared with us, but maybe if you could give us your thoughts around that.
Paul, do you want to take that one?
Yeah, I guess my bias, selfishly, is to not sell equity out of those plants because that obviously is the most expensive capital. So it's better for Plug, but we have to think more broadly than that, given the breadth of agenda that we have and the capital needs and the solutions that we have and the timing and also the partners that we're working with. I mean, in the case of Fortescue, the fact that they've got interesting investment alternatives and platforms that we can co-invest in their platforms, that can be a meaningful opportunity for us. And so we've not necessarily acted on some of those opportunities. We've continued to nurture them, and we continue to see more expressions of interest with multiple parties that would like to take equity stakes in our plants. And so we're going to continue to nurture those concepts and discussions and in context with other alternatives and work towards what we think is the best answer. Hopefully that helps, Martin.
Yes, it does. Very helpful. Thank you.
Thank you.
So that is our last question for the day. I appreciate everyone attending the call and asking your questions. And as Paul mentioned, we will be having our January update calls we do every year to provide you insights into our strategies for 2024. So thank you very much, and look forward to talking to everyone in the near future. Bye now.
There we go. There is our earnings for Plug Power. Thank you very much for joining me. That was an unusual, typical really. It was of the CEO, the way they present things. Very short earnings, and very disappointing to see. I've got to stop doing this muting thing. I do apologize. Thank you very much for that. Sorry about that. I just did say that I bought another 400 shares. I think it's overreaction once again. And I looked at the financials, the balance sheet, and thank you very much, everybody, for letting me know about the sound. It's funny how everybody reacts to the sound. Plug it in. Look, I'm looking. Look, what? Yes, I can hear you. It's funny how everyone reacts, and then you have to catch up with me. But yes, I bought another 400 shares, and I lowered my average dramatically down. Where we were before the call was down 25%, and I'm down 25% now after the call because I bought more. I've lowered my average dramatically. Let's see if we can go up from here. I just bought in again at 494, 400 shares, 398, 494, and we're now at 459. So we have dropped a little bit further, but let's see how the average comes down in the morning. Anyway, there we go. It's difficult on the stock market. We heard from one of our guests here today who's having a hard time. He's not one of our members, but he was here earlier saying how difficult. Let me go to the top. He was saying how difficult it is. It is. It's very hard on the stock market. I'm just scrolling up. Lewis Martin. Is he still here? He's having a hard time. It is. Yes, Lewis Martin is here. Just talking to him. He's not one of our members, but it's a shame. Perhaps if you were one of our members, you would know about the extra information that makes it easier. It's a couple of bucks a month. It's worth investing in that. Most important investment you make is yourself, education and knowledge. It's very, very difficult on the markets right now. A lot of innovation, a lot of things that are spending money, investing. It takes a lot to stay in the market. I do appreciate it. This is a good price for Plug. Looking at the financials, the balance sheet, and everything else, and where it's going. I bought more. I think it's an overreaction. So we'll see what happens in the coming days. Careful with alternative energy. H2 cells and electric cars are ancient tech, totally not practical for around 100 years. Nothing more efficient than fossil. That's not true at all. I don't agree with that sentiment at all. That I don't agree with that. There's no numbers, there's no evidence, there's no science that backs up that statement at all. Lucio. Sorry, but I have to respectfully disagree with that comment 100%. I don't agree with that. Let me scroll down. Do I need to upgrade my membership to get audio? Plug it in. Look. Yeah, only gold members can hear what I'm saying. Everybody else is muted. How many shares do you have now? I have 796 shares. 796. Good price point for plug. Lewis Martin, hi there. I said, Lewis, join the family, buddy. We're all winners. We're all winners and losers. Why are you buying trash, Valentine? Well, that's a matter of opinion. I don't agree with you, Valentine, at all. One trash is another treasure. Absolutely right. Okay, it's starting to go up now from where we bought it. Let's see if we can get this where we need it to be. We could easily do that. Martin, look for yourself. First electric cars is older than... That makes no sense. Martin, look for yourself. First electric car. It's older than Ford. That doesn't even make any sense. I don't understand what you mean by that. Anyway, if you're only looking at an electric car from the fact of it's electric, you're missing the point of the software, the robo-taxi, the list goes on. I'm not going to spend 20 minutes talking about electric cars. There's every bit of science and evidence and facts and knowledge that it's there. You know, we have the first robo-taxi in our town today driving around. And sorry, not the first robo-taxi, I beg your pardon. We have the first Cybertruck in our town today driving around. It's been seen. I haven't seen it personally. One of my friends has seen the Cybertruck driving around. There's no question that EV is taking over the world. It's already happened. I don't know why anybody's left to deny it. Anyway, what ticker is trash, Valentine C? Plug, I think. I think he's referring to plug, but there we go. I have to say, even though I've just bought plug, and since I bought it, it's going up, which is good. It's an overreaction. The balance sheet is good. The amount of debt, the whole thing is fine. It's an industry that's massively investing for the future. Capital investor. In fact, I've just shown you. Let me just bring it up on the screen so you can see what I was looking at. If we look at the numbers, we're not interested in people's personal opinions. I know the CEO sounds like he's drunk. I know the lady that was handling the call hasn't got a clue how to manage the intercom system. Some of the questions were very uneducated. One guy even said, I'm going from call to call. I don't know what I'm doing. People are investing in stuff they don't understand. That's got nothing to do with it. Not interested in that. I do my own research, thank you very much. And we use our software here to give us the numbers. And if we look at the best case scenario, remember we can add 20% to these numbers because this was before we went down 20% tonight. So in best case scenario, it's undervalued by 70%. Best case scenario, 2 quarters from now, that's where we're going to be. No question. Rates are coming down in the spring and Texas will come online and we'll be up 70%. So that's the best case, which is where we're going to be. Base case, 20% undervalued because we dropped 20% when these prices were run through our software. If we look at the worst case scenario, $3.68, when everything in the world has gone wrong for plug, and that isn't the case at all, the worst case scenario would be 39%. And again, we can take off 20% because it went down 20% after hours. So that means we're down to 19% overvaluation. And for a high-tech stock, you can allow 25% overvaluation for a growth stock. We know where this stock can go to. So the worst case scenario is still under a growth case. So the Wall Street target of 158 upswing is under an estimation. So I've got no issue with that whatsoever. If we look at the, this is just numbers and facts, guys. If we look at the revenue, it's up 14%. estimations when things come online, we're going to be exploding. So no issue there. If we look at the debt, the assets 5.6 billion, liabilities 1.8 billion. So we are on the right side of that. Efficiency, no, not right now, because we're spending money. Capital expenditure is going into the business. Profitability, obviously, it's 26 because we're spending money. We're spending more than we're earning. So there we go. 26 is obviously low, but that isn't as low as it could be. Plug solvency, well, excellent. Low DE, short-term solvency is good. Long-term solvency is good. Negative net debt. 50 on the solvency score for a company that are spending the way they're spending is absolutely excellent. That will be improved. As you've just heard from the CEO, they are about to start, a lot of these plants are coming online, so they'll be spending less. So that's a good number. Wall Street looking at who don't even know how to analyze this kind of stock. Any high growth stock, future stock, Wall Street are rubbish at it. They're not investors, they're traders. And they give it, even on the lowest case scenario, a 9% upswing. And again, we are now down at, what was it, $4.50. This was 20% above where we were. So whichever way you look at it, Plug is a good price. Simple as that. The only inside trading we had was very, very small. In fact, it was $230,000 worth of shares sold out. That's nothing. That's more of a tax position. So there's no issue here whatsoever. It's a strong buy at this level. No question about it. So there you go. No doubt in my mind. That is a good valuation. So if you are simply looking at numbers and you're not following a trend and what people are telling you online and all the rest of that rubbish, then it's clearly a good investment as far as I'm concerned. Anyway, Plug will reverse split and go to zero. Valentine C, no. It can't go to zero. I've just shown you the balance sheet and the numbers. What you're saying is just some number from somebody who just likes to get attention. That makes no sense. It's not based on any numbers whatsoever. I've just shown you the numbers. I've shown you the balance sheet. I've shown you the reality. What you've just said there actually it doesn't even make sense. Saying it's going to zero, I might as well say it's going to $1 million. I mean, it's not based upon any facts, knowledge, information whatsoever. So anyway, I don't agree with that. Hi, Martin. What have you been investing in today? I've just bought 400 shares of Plug, and I've just bought another 100 shares of Robinhood. You have to go outside to see it, Martin. You have to go outside to see what? What do you have to go outside? Oh, the trash ticker. Oh, yeah. Anyway, looks like the stock market might roll over again. That's already happened. Anyway, Plug Power is starting to go up from where I bought it. That's good. And we'll trim that back when it does because it's over allocated. All right, that's it from me. I will put out Plug earnings later on as its own video. I think we've covered all the questions. It's once again, when I open the questions up for non-members, you do get these silly comments that are not based upon any actual information at all, just a matter of opinion. Not even an opinion, just picking up numbers out of the air. Anyway, the Cybertruck. Yes, the Cybertruck. Oh, you have to go out. Oh, yes. You have to go outside to see that. No, you're right. You have to go outside. One of my friends saw it. Yeah. I didn't see it. I heard it on Facebook that someone in the town had seen one. Anyway, that's it from me. I'm done. I'm out of here. Thank you very much indeed. Another fine evening. And that's it. Rock and roll. Let's look where space is. It held up. It went down after hours, but it's gone back up again. So very, very nice indeed. Good day. When you consider how much the stock market has gone down, Virgin Galactic has done very well. What kind of software do you talk about that you use, Privet? I've got software with Alpha Spread. I am a partner with Alpha Spread. I provide a premium service that you can use. I'll give you the link for it now. Here is Alpha Spread. If you want it, non-members will pay the full price. My members will get a 10% discount, which means you will end up getting my membership for free. There is the Alpha Spread link, and here is the video, which will give you the code for members only. Only members only can see this. and this will give you a 10% discount, which will make my membership free. If you take all the advantages for my membership, you get at least 20 times back, way more than that now. If you go to Sensei's program and Alpha Spread, we're paying you to have the membership. I've negotiated great deals, as I always bring my members the best deals anywhere. All right, that's it from me. Let's have a look. Did we have any? You're very welcome, Privet. Did we get any super chats tonight? Any new members? I'll roll the credits. What the heck? Just in case I missed one. Just in case. Just in cases. Let's get out of here. Another fine evening. Let's roll the credits and let's wrap up today. All right, here we go. Roll the credits. Shooby-doo. Do. Stars of our show, followers, Fab Berry. We got a follower on Twitch tonight. Subscribers, Savage 20p, Daniel Lionel as well. Thank you very much indeed. All right, let me just close down a few of these windows. I've got windows coming at me ear holes. Let me close down some of these. And all right. Stars of our show tonight. We don't need that. We are back in the morning for the opening and closing bell. Of course, we've got the Friday phone-in. Members can all phone in, and those that join tonight can phone in the morning. Thanks, says Privet. Best YouTube channel, TV channel in the world. Luciana, in my opinion, hang on, let's scroll to the bottom. That's it. I've got through all the comments. Okay. Let me just go through a few things. Yes. Plug power, just trying to come back up now. Right. Let's close that down. And I will see you all back in the morning. Just going through a few things, make sure I've got everybody. Sensei likes to see this. He loves when I do this. Let's have a little look. 14,449. The channel is growing like every day. It just grows even more. The numbers get crazy. 11,515 subscribers. We've had a great day today with the subscribers. Thank you very much indeed. Did everyone tap the like button? I hope you did. Smash the like button. I'll see you back in the morning. That's it from me. Thank you ever so much. Let's look forward to another day. What are the next earnings? Next earnings now are next week. Nothing tomorrow. That's it from me. Take care of yourselves, your money, your crypto, yourselves, and yourselves, and yourselves, and yourselves, and each other. Bye-bye for now.